Almost nobody covers this stock. Here's why they should. In 2025, Jushi Holdings reported a tax bill of $35 million on a pre-tax loss of $34 million. A company that lost money before taxes still owed the government $35 million. That's Section 280E, the tax code written for drug traffickers, working exactly as designed. First, the business itself. Jushi is a vertically integrated multi-state operator running 42 dispensaries across Virginia, Pennsylvania, Illinois, Nevada, Massachusetts, and Ohio. Revenue is small but stable, about $263 million in 2025, up 2%, and roughly flat with where it stood 3 years ago after the boom unwound. This is not a growth story. The drama is below the gross profit line. Here's the first anchor dragging it under. Because cannabis is Schedule 1, Section 280E lets Jushi deduct the cost of its product, but almost nothing else. So the IRS taxes a number close to gross profit. Even in a year, the company loses money. The result, in 2025, was $35 million of tax expense on a $34 million pre-tax loss. A normal business with that loss pays zero and banks the loss for later. Jushi paid as if it had earned a profit it never made. And this isn't a one-year fluke. Look at the pattern. For 3 straight years, Jushi posted pre-tax losses, and for 3 straight years, it paid roughly $32 to $35 million in tax anyway. Added up, nearly $98 million of income tax over 3 years, against cumulative pre-tax losses of about $84 million. The tax bill barely moves with profitability, because it isn't really keyed to profit. It's keyed to gross margin. But here's the twist nobody talks about. That $35 million tax expense is mostly on paper. In actual cash, Jushi paid just $2.5 million of it in 2025. The other $32 million went onto a balance sheet pile of unpaid contested taxes that grew from $144 million to $177 million in a single year. Jushi is financing itself with an interest-bearing IOU to the IRS, and that IOU is now nearly double the company's entire stock market value. Which brings us to the balance sheet. Years of impairments and losses have driven the accumulated deficit to $627 million, leaving shareholders' equity at negative $115 million. Book value is gone. On top of that sits about $206 million of term debt and $65 million in finance leases, costing $41 million of interest a year, which is more than 15% of revenue. This is a thin equity sliver on top of a large, complicated liability stack. Now, the part that works. Strip out the tax code and the debt, and the operating business is healthy and getting healthier. Gross margin reached 45% in the first quarter of 2026. Company reported adjusted EBITDA hit $50 million for the year, a 19% margin, up almost 9%. And critically, operating cash flow was positive, $18 million, because most of that tax expense never leaves as cash. For a company this size, that's a genuinely functional operation buried under a punitive structure. So what happens when the switch flips? Part of it already has. The medical-only schedule. 3 order that took effect in late April removed 280E from medical income, and management says about 60% of Jushi's revenue is medical, so that relief should start showing up in this year's tax bill. The bigger prize is the Drug Enforcement Administration hearing that opens June 29th, which could move cannabis broadly to Schedule 3 and lift 280E from the rest. On 2025 numbers, removing the full $35 million tax turns a $68 million net loss into roughly a $34 million loss, and stops the $32 million a year piling onto that unpaid tax mountain. But be honest, even full relief only halves the loss. It doesn't make Jushi profitable on its own. The $41 million interest bill is still there. Then there's Virginia, Jushi's most profitable market, and its path this spring was a roller coaster. The legislature passed adult use sales. The governor vetoed it in May, and then both sides cut a budget compromise that revived it, with retail sales now targeted for July 1st, 2027, and up to 350 licenses phased in over time. That matters because Jushi already built 6 superstore dispensaries in Northern Virginia designed to flip to adult use, and it's racing to double its cultivation to feed them. Add a refinancing that cleared its 2027 debt wall with no dilution, a Pennsylvania adult use bill still in play, and at a $96 million market cap, Jushi looks more like a takeover target than a buyer. So, what is it worth as a normal business? Here's the surprise. On enterprise value, Jushi is not cheap. At about $357 million of enterprise value against $50 million in adjusted EBITDA, it trades near 7.1 times, already above the average multi-state operator. The cheapness is all in the equity, which at $96 million is just a third of one-time sales. Re-rate it to a consumer goods multiple of 10 times normalized EBITDA, and the equity could be worth roughly 2.5 times today's price. But subtract that $177 million tax reserve as a real claim, and it's worth less than today. The whole bull case rests on one assumption, that the back tax mountain is resolved, or never collected. So here's the framework. Jushi is a functioning operator wrapped in a balance sheet built by a punitive tax code. The bull case, a broad schedule. 3 order ends 280E for adult use income. The $177 million tax reserve resolves favorably. Virginia switches on, and a $96 million equity re-rates several-fold. The bear case. Rescheduling stalls or stays medical only. The IRS enforces that reserve, and the leverage cuts the other way against negative equity. Watch 3 things. The effective tax rate, that $177 million line, and Virginia. That's the setup, not a recommendation. This entire analysis was built using RoboSystems, an open-source platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.